Mhm. Okay. Assalamu alaikum, everyone, and good morning. I'm Dr. Mansoor Ahmed, and I, with my colleagues, will be moderating this webinar on inheritance tax under the platform of UKIPPO, and will be discussing issues and considerations which relate to inheritance tax. It's a very important topic for all of us. Certainly, it relates to our present life, but also our future. I will first of all introduce the panel. As I said, I'm Mansoor Ahmed. I'm consultant pediatrician at University Hospital of Derby and Burton, NHS Foundation Trust and co-president of UKIPPO. And with me, I have Dr. Naseem Mahmood, who is a consultant pediatrician at Alder Hospital at Liverpool. He's also co-president of UKIPPO. Then I have Dr. Imran Zamir. He's consultant pediatrician at Manchester Foundation Trust and General Secretary of UKIPPO. Dr. Ehsanul Haq, who is consultant pediatrician and joint secretary, UKIPPO. Then I have Jonathan Godfrey, who has spent 37 years in pharma sales, realizing that where doctors were very good in their own specialty, but not so good with their financial affairs, he then decided to change and to source the best-in-class financial advisors to facilitate holistic financial education for medical fraternity. And finally, I have Mr. Giles Cooper, who is a chartered independent financial planner for over 30 years, extensive specialist experience in financial advice. And Mr. Cooper will be the one who will be delivering an all-important talk today. So I'll say a few more words about Giles when I hand over the reins to him in a short while. Just a couple of housekeeping announcements. I would request all the delegates to kindly keep their cameras and mics off. If they have any questions, kindly feel free to use chat functionality and pose your questions there. We would expect all the questions to be generic questions rather than personalized questions. And you might have already noticed that we have started recording this meeting, and we hope that no one has any objections to us recording this meeting. So without any further delay, I would like to hand over to Dr. Imran Zamir, who will give us a brief introduction about UKIPPO.
Thank you very much, Dr. Mansoor Ahmed. I would like to share my slides. And can I just get confirmation that everybody can see those?
Yes, that's fine. You can just
Thank
get
you.
into the reading mode.
Yeah, thank you. So I will just give you a brief introduction that what is UKIPPO, and we are doing different activities since our inception. And today's webinar is one of those. So our journey started after I met Dr. Naseem Mahmood in 2022. because we already had a group of pediatricians in northwest of England, and we had around 40 members, and he gave me us and we shared the idea that whether we should have similar group of pediatricians of Pakistani origin across UK. And after that, we discussed a few times, and then we met in an event in Manchester on 9th March 2024, where there were around 15 to 20 pediatricians in an apnea event. And that's where we had a first meeting, and we formally started this journey. And since then, we had initial slightly slow progress, which is expected in any new organization, but we registered in 2025. And then we had our first annual conference, which many of you have attended already on 12th July 2025. And we promised you that by the next year, we will be launching our formal membership, and we will be also launching our website and other programs which were in the pipeline. And we know that everything is dependent on the finances. So that's why there was initially some constraints, because we wanted to be very fair, honest, and open organization. And that's our motto, that we remain without any political affiliations, and we only work for the benefits of pediatric professionals and child health. So that's one unique thing about our college, as well as pediatricians generally, that we don't only talk about our members and also about our professional group, but we also talk about the child rights, not only in our country, but globally. And we have done many things on that line already through our organization. This was the first group of people when we met. And these are the objectives which we have previously mentioned in our conference as well, that we want to play an advocacy role for our members on different forums in UK. We want to enhance education and guidance for the members. Through our website, we will be launching members-only area guidelines and other support networks. We have already helped many doctors to get through their career progress with from getting jobs to getting to higher positions within the NHS. And we also aiming that to have more training for the leadership. And as we conducting one of this webinar, we only don't want you to progress in your academic journey, but also to generally well-being of our members. And we would like to collaborate in future with further more organizations, like we are doing a webinar today. These are the some of the achievements. I have not mentioned all because there are too many to squeeze in such a short time. We have one of the most popular one is the portfolio pathway, like many other specialties, and we have done some individual sessions with the people who were on that journey, but we have also held few webinars, and the most recent one was in February this year. We have had a medical leadership webinar last year, which was very successful, and we want to continue that in future. One of the aim is that our members, we don't want them only to be a silent member, but also to be heard and to participate actively in the leadership roles in NHS. And we have helped with a lot of interviews. We have individual one-to-one help for our members for different reasons. We have different groups within our organization, including women leadership, ST application, portfolio pathway, and because of my own interest, we have also have already started an endocrine and diabetes special interest group. We have some local networking events, and we are had a conference last year, and we're planning the next conference in September this year. This is our current governing body. Because we have not had any elected membership yet. So this is the interim body which is taking with that aim that we will be able to have formal membership, and then all the council members will be elected through voting. Dr. Naseem Mahmood and Dr. Mansoor Ahmad both are in the meeting today, and they are co-president. Dr. Kafil Shadani is from Republic of Ireland, and he's our vice president. I myself working as a general secretary. Dr. Mujahid Khan is our treasurer. Dr. Ehsanul Haq also in the meeting is the joint secretary, and Dr. Sadia Zishan is our social secretary. We have different committees. We have a UK regional chair, which is Dr. Qamar Ali. We have a training committee, and chair is currently Dr. Muhammad Bilal Mazhar. We have Republic of Ireland regional chair, Dr. Javed Saeed. We have pediatric surgery chair, Mr. Khizar Mansoor. Women leadership chair is Dr. Nabia Asad. ST application support chair is Dr. Shaila Jadoon, and training and education chair is Dr. Mohsen Chima. We have many collaborations, and we have recently had a successful meeting with Apna Pediatrics from US, and we are planning to have MOU with them in future, and we are currently working on this. This is one of the series of the financial planning webinars we are attending today, and there will be many others coming in future. We will be launching our formal membership soon. Our website is already up and running now, and we have a future plan for elections. That's a brief introduction, and I will pass on back to Dr. Mansoor Ahmad to continue with today's webinar. Thank you.
Thank you very much, Dr. Imran Zamir. That was very helpful, and thanks again for keeping to time as well. I would like to now take this opportunity to introduce Giles Cooper. Now, with over 30 years of experience, Giles has a long track record advising investors, private clients, companies, and charities. Giles provides unbiased, regulated advice tailored solely to each client's goals. I'm particularly interested in hearing about major changes coming in April 2027, when unused pension pots will be brought into the inheritance tax net and potentially taxed at 40%. Giles works with clients who want more than generic advice, and is very good at creating clear, personalized strategies focusing on three critical areas. First one is growing and protecting investment. Second is optimizing pensions to ensure a comfortable and secure retirement. And lastly, but never the least, minimizing inheritance tax exposure, allowing clients to pass on substantially more to their loved ones instead of the taxman. So that's a very brief introduction about Giles, and I'll now hand over to Giles.
Luke, we've got some slides for you, just to guide me as to what to say. But it's in principle, inheritance tax is becoming an increasingly convoluted area, with new rules coming in all the time, such as it never seems to be standing still. But I think it's fair to say that the more and more people it used to be just the richest people getting caught by inheritance tax, but now it seems to be a huge proportion, and we've seen the tax receipts for the government going up 5, 6, 7, 8 times in terms of inheritance tax receipts. So it's become a big thing that now seems to apply to everybody, as opposed to just a chosen few rich people. So it does become relevant, and so I thought I'd come up with a few slides as to some of to cover at least the basics, to understand what is included in your estate and what isn't, and how it's taxed at the outset. So if you could move me on to the next slide, that'd be great. Can you hit next? Wonderful. I think you've just covered this one, so perhaps we can move on to the next slide. And the next one. Thank you. Essentially, inheritance tax is paid on death, and basically they put together your entire estate, which is all your assets and investments, and then they add that up and they charge you 40% tax on all those investments on death. There is an allowance of £325,000 that is effectively a personal allowance, which is tax-free before the 40% inheritance tax kicks in on the rest of the estate or on all your assets. You can actually boost this to £500,000 per person. And that's done by something called the residence nil rate band. Now, 325,000, by the way, is the nil rate band in common parlance. But the residence nil rate band is different and is additional, and that is worth £175,000 per person. And this is when you are passing on property you own to a lineal descendant. Now, that means children, grandchildren, legally adopted children, and is also, but also in order to qualify for this extra £175,000 allowance, you also need to make sure that your total estate is worth less than £2 million in total. After which there's a sort of tapering, which means that you get precluded from this allowance. So and you go back to the £325,000 allowance rather than having £500,000. So there are various obstacles you need to get over in order to get this extra £175,000 allowance to boost your total allowance to £500,000, and that's per person. So husband and wife, they will have £1 million between them. Yes, and that's because there's no tax on transfers in between husband and wife or people in a civil partnership, such that if the spouse gives to the other spouse on first death everything that they own, and they don't give anything to anybody else, that is all tax-free, inheritance tax-free, that is, and the allowance can also pass from spouse to spouse. So if they hadn't used the first death spouse hadn't used any of their allowance, then they can pass it to the second spouse, such that the second spouse could have anything between £650,000 or £1 million as allowance on second death when the inheritance tax becomes due. So could you go on to the next slide, please? Can we do next? So what is taxable? What is making up your estate is what this is about. It's essentially all your UK assets, regardless of where you live. So even if you're a foreigner and you've got UK buy-to-let, for example, or property over here, then it all comes into UK inheritance tax. And for all those like ourselves who are long-term resident, as they say, of the UK, then our worldwide assets are all taken into account. So if we've got a house in France, or if we have assets abroad, companies abroad, all of this, everything becomes part of our total estate, subject to UK inheritance tax once you're a long-term resident. So who is a long-term resident? A long-term resident is a new thing that's only just recently come in. And essentially is somebody who's lived here for 10 out of the last 20 years. And this is taking over from what was called domicile before in the UK. So these are new rules. As I said, they keep changing the rules, and it's becoming more and more complicated. But essentially, somebody who's lived here for 10 out of the last 20 years is classified as a long-term resident, UK resident person, and thus subject to UK IHT. And if you feel that you might get away from the UK IHT and you would like to disappear from this country and go and become tax resident somewhere else, you might think that you are outside the UK inheritance tax net. But no, there is a tail which can go up to a tail period of up to 10 years after you actually leave this country and become tax resident somewhere else, where you still qualify for UK inheritance tax on your worldwide assets. And even after that, you'd still be taxable on your UK assets. So the bit that you were kindly mentioning was things have been changing, and one of the main changes that has just taken place is that from April 27, so next year, pensions, which is one of people's largest assets, which previously were outside of your estate for inheritance tax purposes and would pass to beneficiaries tax-free under certain circumstances. That is no longer going to be the case, and they're going to be included in the inheritance tax net, which will give Rachel Reeves a huge boost in her inheritance tax receipts going forward, I would suggest, because after one's main residence, often the people's pensions are their next biggest asset that previously were outside of their estate and suddenly are going to become part of their inheritance taxable estate going forward. Next. Yes, there are certain, apart from I talked about the allowances, the 325,000 personal allowance that everybody has, and the 175,000 additional personal allowance that you may be entitled to, depending on your circumstances, your total estate, and your and also your who you're leaving your house to if you own it. But there are other exemptions and allowances that have been around for a long time, and you are allowed to give £3,000 each person is allowed to give £3,000 a year to people tax free, and if you haven't done so last year, you'd be able to give £6,000. So you can carry forward this £3,000 allowance into a year, into the current year, for example, if you haven't used it last year. And but that's as far back as you can go, and you always use the current year's allowance before you use last year's allowance, so to speak, in terms of the pecking order. There's also the small gifts allowance. That's essentially you're allowed to give unlimited amounts of gifts of £250 each tax year, as long as you haven't used other allowances for that person. There are the gifts for weddings, which is a bit esoteric, but essentially you can give £5,000 as a tax-free gift to your children when they get married or go into a civil partnership. £2,500 the same for a grandchild or great-grandchild, or to anybody else you can give £1,000, which is precluded from inheritance tax. Then you've got this other one, which actually is not necessarily that widely known or understood, but there's something saying that if you are earning lots of money, and let's say you're earning £150,000, you're only spending £100,000, and your total expenditure is £100,000, and that you have £50,000, therefore, of surplus income that you can demonstrate is surplus income, then you are allowed to give gifts out of normal income, as they call it. And what this actually means is that this gift has to be a regular gift. So it's like it could be an allowance to your child, for example, where you give them £500 a month to help them with their expenses, for example. And if you can demonstrate this is a regular gift that is taking place on a monthly basis, for example, and has been happening over a certain period of time, and that it doesn't affect your own living standards because it's excess income, then these gifts which can mount up actually over a period of years, can be precluded from your inheritance tax estate and are very valuable, considering 7 years worth of £1,000 a month to your child, for example, would tot up to quite a lot of money. I can't do 7/12s, but if that's 84, if that's 84,000 over a 7-year period, then 40% of that is going to be a very large tax which you would be avoiding on a situation like that. Next, please. Gifts. So people are thinking, well, how do I avoid? I've got a large estate, I've got lots of assets, um, and it adds up to quite a big number. And then you think, gosh, 40% of that means that when I die, I'm going to be paying an awful lot of money to the revenue. So one of the easiest ways, I suppose, or simplest ways of avoiding that tax is to give the money away. Give it away, and then if you live 7 years, once you've 7 years after the gift has been given, after that, the gift is taken out of your estate. It's no longer part of your estate for inheritance tax, and therefore reduces your estate substantially, or can do. And there's these rules that if you die within that 7-year period, that there's a tiered rate of tax charge, such that if you, for example, you were to die between 5 and 6 years after giving the gift, instead of paying 40% on that money that you've given away, you'd only pay 16% on the value of that gift according to those tiered rates. So that all sounds very wonderful, but what people don't really sort of click on these things is that when it comes to probate and once you've died, the first thing that actually goes into the pot when measuring your estate and how much tax to pay are your gifts. So that's the first thing that goes into the pot. So if you've given away 100,000 5.5 years ago, let's say, and you've got your 325,000 personal allowance, the first thing that goes into the pot is your 100 grand gift. And that will reduce your personal allowance to 225,000 because the whole 100,000 goes into the gift. So you don't actually end up getting any benefit from the tiering that I've just mentioned. So that'll be only if your gifts are in excess of your allowances that you'll start to benefit from the tiering when it actually comes to your death. It's misunderstood and sort of a bit of a tax trap, really, because it's a benefit that generally people don't actually get. So could I have the next slide, please? So people think, well, I could give it away to my children, all this money, but maybe my children are a bit young and maybe I don't want them to go off and lead a sort of a nefarious life. I want them to work and things like that. And if they've got lots and lots of money, they may spend it how I don't want. So a lot of people might consider instead giving the money rather than direct to people, putting it into a trust, whereby you've actually given away the money. So it is that gift, and the 7-year clock starts ticking because that gift is considered a potential exempt transfer, is what they call it. But it's that gift where you've got to live 7 years. So it is a potential exempt transfer, your gift into the trust. And the trust essentially has set laws, it has trustees, and it has beneficiaries. And you are the set law, you who are providing the money, putting the money into the trust. And then you've got trustees that can be yourself or can be separate people who are looking after the trust thereafter. And then there are beneficiaries who are the people who are going to receive the benefit of the monies inside the trust. So that's how a trust generally works. Now, from an inheritance tax purposes, for the trust assets to be outside of your estate, you need to have lived the 7 years. But also, you also need to make sure that you do not have any financial benefit whatsoever from the trust for the trust assets to be outside of your estate from an inheritance tax point of view. So people have been caught who have got slightly more complicated trusts where they perhaps might have put their overseas holiday home into trust, and then they've gone over and gone and lived in that holiday home for a couple of weeks on a nice holiday, but paying no rent to the trust, because remember, they no longer own it, and because the trust owns it. And then if the revenue caught up with that, they could actually bust the trust and then make all the trust assets subject to inheritance tax that previously wouldn't have been. So you have to be careful in terms of what you do when you have these trusts, to make sure that they continue to work from an inheritance tax point of view. And there are lots of different types of trusts, whereby you can. Yeah, there are some. Generally, if you benefit from the trust, you can bust it. But there are two or three types of trust where you can derive, as a settlor, some kind of benefit from the trust going forward, and for it to still work from an inheritance tax point of view. There are things called discounted gift trusts, reversionary trusts, but there are all kinds of different trusts, and how you combine that with the investments that are inside the trust is reasonably convoluted, and it's very important to make sure you've got the right trust, the right investment, the right wrapper, and that you stick by the rules of the trust, such that you don't stop it from working. So, can I have the next slide, please? Yes, we were talking about the various different reliefs you could get. Well, those were personal tax reliefs. So the 325 that you get yourself, and potentially the residence nil rate band of 175,000 on top. But certain assets are excluded from your estate for inheritance tax. And there's something called business property relief. And this is a relief that reduces the value of your qualifying business assets when passed on in a person's lifetime or on death. And I mean, frankly, this is based on the inefficiency of having a very large inheritance tax bill on businesses, such that they had to if somebody died and they passed the business on to, let's say, their children, and suddenly they're running a business that's actually doing okay, but not necessarily making an awful lot of money. And suddenly the business value, let's say, is £1 million, and suddenly when dad dies, the Inland Revenue come knocking on the door for £400,000 inheritance tax, which is what used to happen. So, in which case it's very inefficient for the economy and for the government, because people then have to sell the business in order to raise the money to pay the tax. And that's not good from an economy's point of view, and also certainly not good for the children's point of view. So as a result, they provided business property relief, and this was to help trading businesses continue through generations. And that was the history, really. And so nowadays, if you pass on a trading business, then it qualifies for 100% relief, i.e. no tax, on the business, if it's as long as it is a trading business. And this includes private companies, unlisted companies that are trading businesses, and also includes those that are listed on the AIM market, which is a sort of a market unlike, so it's a place where you can actually trade the shares, rather like the stock market, albeit it's not the stock market, it's the alternative investment market. You get the third point is probably not going to really qualify for most people. That's talking about a 50% relief on quoted shares. So if you've got a company that's quoted on the stock exchange, for example, and you own more than 50% of it, then there are some reliefs you can get there too. Although I've never found anybody who qualifies for that. But so that's fairly esoteric. The key conditions is, though, that it must be a trading business. So an investment business is the alternative, which doesn't qualify for the relief. So, for example, a company with a whole lot of buy-to-let properties, or something like that would not qualify because the property would be considered an investment, and therefore that would be an investment company and therefore not qualified for the reliefs. So it has to be a trading business. And then you have to be careful about the amount, the proportion of assets in the business that are not trading. So you could theoretically have, well, you've seen businesses like this where the business is not doing so well, but they have got a large cash balance. They own their business premises, for example, which are worth a large proportion of the total value of the company, such that it turns the trading company into an investment company and therefore not qualifying for the relief. So one has to be very careful about it being a trading business. Could you go on to the next slide, please? Agricultural property relief, probably not a big one for this particular audience, but you get similar reliefs of with agricultural land and property as well, which is called agricultural property relief. And there's a similar sort of thing to business property relief. Could we have the next slide, please? Now, they brought in new rules, as they're always doing this, they're always bringing in new rules. They put pensions. Pensions are coming into inheritance tax estates next year in April. But what has just happened on the business property relief is now they are saying that they're going to cap this relief at £2.5 million. I think you may have noticed before everyone went onto the streets when they had the cap at £1 million before, but they've raised it to £2.5 million, such that your business property relief, you get 100%, you pay no tax, therefore, on the first £2.5 million of value, but thereafter you pay 50%, i.e. 20%, 50% of inheritance tax rate, which is 40%. So therefore you'll be paying 20% on the value over and above 2.5 million. So this could hit farms and estates quite hard. Similarly, there are shares in, like the AIM shares that I mentioned, they'll be getting 50% relief, i.e. 20% tax, regardless of their value. There is an option, as it's saying, well, because it can be quite onerous, like where I mentioned the chap who had a business and suddenly would have to have a £400,000 tax bill or something like that. But previously they were quite tough and expected this money to be paid almost immediately. But in many cases, they allow this to be paid over a period of time such that you can effectively budget it for the next 10 years, so you perhaps not have to sell your business, for example, because you can spread it over 10 years, interest-free in annual installments, and still and therefore not be in too much trouble to spread the payments. Next slide, please. The alternative way, if you can't reduce your estate, those are various ways we're talking about reducing your estate, i.e. reducing the amount that is actually going to be taxed at 40% is one way of doing things. But inevitably, it's going to be impossible to do that for all your assets. I mean, things like your main residence, which presumably is very often people's main asset, and they're living in it, it's very difficult to actually get that asset outside of your estate. There are things you can do to mitigate, but generally it's very hard to remove it from your estate because you can't really give it away because you're living in it. And if you give it away and you're living in it, then that's a reservation of benefit, and therefore it actually remains inside your estate. So the alternative ways is to come at it from a different point of view and to realize that you're going to have a big inheritance tax bill, and then to cover it through life insurance such that that when you die, a sum assured is paid out to your beneficiaries, and hopefully that sum assured is then going to effectively pay the inheritance tax bill. And given that both the inheritance tax bill and the life insurance are triggered at the same moment, hopefully one will cover the other. And that way you can be sure that your descendants don't then have to be faced with a very large bill because it's all paid for by the life insurance policy that you have set up. Similarly, with people giving gifts away, and cognizant of what I was saying about the fact that gifts are the first thing that comes into account when assessing you for inheritance tax, and thus generally take up the most of your nil rate band or your £325,000 allowance. You can ensure that over a period of 7 years, such that if you're if you were to die within the 7 years of the gift, that this 7-year relatively cheap insurance policy will pay out the inheritance tax liability that perhaps you are trying to avoid. So that is covered. And that is a relatively cheap form of insurance, actually, compared to the whole of life. But there are other ways of doing it, and insurance is a way of covering the tax that you will be liable for if you can't mitigate it through other ways. Next slide, please. So I think I may have mentioned one or two, but there are many, many, many different ways of skinning said cat, and the lot of ways of mitigating inheritance tax. And we advisors are looking at all the various different options, and we try and work out which are the most effective for people. But one of the most common is looking at discretionary trusts, increasingly so now, with pensions coming in next year. Discretionary trusts are is something that people really are looking at, but they are complicated, and it's important to get the right one, and you really do need good advice on that. And it's going to vary depending on every individual's personal circumstances, frankly, as to what's the best solution in order to mitigate the inheritance tax, and if it's a trust, what the best trust to use is, and that's going to be very personal depending on individual circumstances. And there is another route, for example, is there's something called the business property relief funds. These are funds where, if you remember, I said that trading companies get all this business property relief, i.e. 100%, and essentially there are funds that will hold. I know one that holds up to 400 investments, actually, 400 different companies, and they're all private companies, all qualifying for business property relief. You can buy shares in the fund effectively, or units, depending on how you read it. And then that investment would be outside of your inheritance tax net after 2 years of holding the shares. So that is quite a useful one for those that don't want to give the assets away because they think they might need them in the future. They don't want to pass it into trust where they can't touch the money again, but they want to move money outside of their inheritance tax net, but also be able to touch it and to use it. So you carry on owning these shares, and if you want to sell them and benefit from the money, then you can. So it precludes you having to give the money away to avoid the inheritance tax. Next slide, please. So, those are a couple of the solutions that I just throw in there. But there are often lots of different strategies that can be used in order to, and that's going to vary and be very individual and personal. And here we just put down some of the main areas that are going to make up your state. So the main residence will probably be the largest one for a lot of people. Then they may have investment properties like buy-to-lets or holiday homes, which can be quite valuable. Naturally, there are investments like that. ISAs, people think ISAs are inheritance tax-free. They're not. They are part of your estate. But ISAs and now, from April next year, pensions, which is a very big asset that people will be getting into their estates and being taxed. And then we've got your business, of course, and whether that's a trading business or or whether it's an investment business, and it's important to really work out which it is, because you may think it's a trading business and find it's an investment business. And then cash, of course. So these are the various assets that can make up your estate that might need mitigating. So I hope that gives you an idea of how inheritance tax works, and how it affects individuals. But it is a very individual thing. We need to really understand individual circumstances in order to, and assets, and in order to come up with a plan for how best to mitigate these situations. I do hope that gives everybody a good idea, and I'm happy to open up to questions if perhaps I ought to hand over to you, Johnny, or
yeah, no, just to say thank you so much, Giles. That is a very tricky subject, and I think you've done a sterling job there. So thank you. And also, yeah, we have the opportunity here. Please take advantage of it. Giles is here to answer questions. Please try and keep them of a generic nature for now, with the caveat that everybody is entitled to speak to Giles and or his colleagues after this and discuss their own personal circumstances for as long as it takes, and there's no charge for that. But just for now, if we have some salient questions, then please fire away. Do we need to unmute people so they can do this?
Imran, Dr. Imran.
Are there any on the chat, actually?
Yeah,
they're on the chat, and as we agreed, I think myself and Dr. Mansoor Ahmad will ask the questions on the behalf of the people to keep us to the time and to keep it concise. So we have a couple of questions from Dr. Taimur. He's asked that if somebody has set up a limited company to buy to let property, and it's an equal share with the children, so what will happen to the shares for that person from inheritance tax point of view?
Can you repeat the question? Sorry.
So it's a buy to let property through a limited company, equal shares between the person and the children. Yeah. So what will happen to his or her share for inheritance tax?
Well, 30% of if it's 30% holding of the company, then 30% of the company's, well, then that'll be part of your inheritance tax debt. Yes.
So okay, but there's a follow-on question that mostly people invest in such companies through a company loan. So if they are given a loan, will be still the same rule, 30%?
So where does the loan come from? The company?
No, the person who has passed away has initially invested in the company as a loan. Yes.
Well, the loan would therefore need to be repaid by the company, and that would be part of his estate for inheritance tax.
So indirectly, still it will be 30%. Is that correct? If I just
well, depending on the value, if he's lent £500,000 to the company, for example, and then that loan to the company would then, on his death, be owed by the company back to him, and therefore that £500,000 would be part of his inheritance tax estate.
Okay.
As the loan value. Sorry, it's slightly complicated by. Yes, that's yes, that would be the case.
Yeah, thank you.
And the 30% shareholding may or may not. It depends on whether it's a trading company or an investment company. May also be part of his estate as well.
Yeah. And the same person has asked another question. It's about private pension. It's just disappeared. Dr. Mansoor Ahmad, can you ask that question?
Yeah. So he's asking what happens to private pensions if children and wife have been put on as beneficiaries as well. So a person dies, but their children and wife are also beneficiaries of the private pension. So what happens from inheritance tax point of view?
Well, the pension will still be going to the beneficiaries, but it will be included in the inheritance tax of the deceased. So there will be tax payable on his death. So while the pension benefits will go to the spouse and children in this case, it'll be the value of the pension will be part of the estate, his estate, for inheritance tax, unless. Oh, sorry. You're saying that he's passing it to the spouse. If it goes to the spouse, then it's inheritance tax free. I'm sorry.
Yeah, but from children perspective, you'll have to.
From yes, the element that's passed to the children, that is part of the inheritance tax estate. So if he's got a pension of £500,000 and he wants 300,000 to go to his wife, then that's inheritance tax free.
Yeah.
But the 200,000 goes to his child will be inheritance taxable, part of his estate.
Yeah, thank you. And the next,
this is post April 27.
Yeah.
Not now. That's post 27. That's the difference. Is the child's 200,000 will become taxable.
Yeah. And will investment in US stock be considered part of taxable estate?
Yes, it would, because it's part of your worldwide assets. So yes, it would be included in your inheritance tax estate.
Okay. Thank you. And Ehsan, you have a question.
Yes, thank you, Giles. My question is about the total, how much is maximum tax-free annual allowance as a gift to the children and spouse? For example, 3 children and 1 spouse. How much can we give? Is it distributed, or is the total amount, or we can give them maximum to each?
Sorry, I didn't catch that last bit.
So if for example, if I'm giving to my children, can I give to my spouse as well? What is the maximum amount we can give tax-free in a year?
Well, you can give as much as you like tax-free to your spouse, inheritance tax-free. So you can give all your assets to your spouse, including your allowances, actually, tax-free. That's no problem. So
is it in single tax year? What I'm just like as a money?
Oh, sorry, you're not talking about on death then?
No.
Oh, right, okay. You can still give as much money as you like to your spouse, and there's no inheritance tax involved at all. And actually, on death, you can do the same. So in life or in death, you can give your wife as much money as you like without it incurring tax. Children, different. Children, yes, there is tax to pay. And it depends what you're giving to your children, of course. So if it's, for example, if it was a property, and you were giving a property to your children, and let's say you bought it for 100,000 a year, and when you give it to your children, it's worth 120,000, then you'd have to pay capital gains tax on the 20,000, and then you could pass it on to your children. But therefore, if you were then to go and live in it, as I said before, you'd have to pay tax to the children on that property. But you can give. I think I mentioned up to 3,000 you can give in free gifts, and otherwise it's a matter of living 7 years. Otherwise, the gifts are taken into your estate. So they'll look back. If you died, for example, you can give the £3,000, or you can give £20,000, whatever, to your children. And if you live for 7 years thereafter, after the gift, let's say it's cash, then that would be outside of your estate for inheritance tax purposes. But if you were to die within that period, then it would still remain within your estate for inheritance tax purposes, and may be subject, or unlikely, but was likely to use your nil rate band, your allowance, and thus the tiered ratings are unlikely to apply, but they will be subject if you were to die within that 7-year period of the money given to your children.
Thank you, Giles. There are a few more questions, but Dr. Mansoor and Imran will.
I think the next question probably has been already answered from Mia Aslam. The annual exempt gift of 3,000 per person, is it for children only or for anyone? So
For anyone, and you can follow, use last year's allowance if you haven't used it, and give up to £6,000 on that basis per person.
And Dr. Naseem Mahmood, you want to ask your question yourself?
Yeah, I think I just wanted to ask for those starters, if you understand that, what is the right age to start inheritance planning? I'm saying this because most of us who came to UK a bit late and are quite late to understand the system. So for our younger members, what's the right age to start their inheritance planning? Thank you.
That is an extremely important question, actually, because obviously the sooner one does it, the better, because given a lot of these gifts and transfers mean that you need to live 7 years in order for it to be outside of your estate. One doesn't want to leave it too late because one wants to live the 7 years. But also there's another element that I perhaps haven't really properly gone into, which is the long-term residency. So for your members who may have come over to the UK recently, who have especially large overseas assets, then there is something called an excluded property trust, which it's worth having a look at. So where you can do some inheritance tax planning, getting a lot of assets outside of your estate, while you are in that 10 out of 20 years. Do you remember I said that you, after 10 years, you start, after 10 out of living here for 10 out of the last 20 years, you will become UK long-term tax resident. If you're before that and you haven't lived in the UK for 10 years, then there's some extremely good planning that you should be looking at before you hit that 10-year mark, which is when suddenly you become fully inside the UK inheritance tax net. Before that, you're not. So not fully. So there's a lot of planning that one can do prior to that, which can shelter assets for the rest of your lifetime. So that's the other area. So yes, always look at it as soon as possible to get the planning into action. Secondly, there's another reason, which is that you can only really shelter in trust into a discretionary trust £325,000 at any one time, because that's your allowance. If you were to put in £500,000 into a trust, for example, you would be taxed 20% on the way in on the 175,000 that's over your nil rate band or the personal allowance. So if you wanted to avoid that 20% tax on the way into the trust, then you stick to the 325,000, and then 7 years later you'll be able to do another 325,000 with no tax on the way into the trust. So if we're talking about doing sort of big sums over a period of time, then the sooner you start, the better, because the sooner your allowances come back again. So that's another reason to start early.
Thank you. Thank you, Giles. A few quick questions, hopefully with quick answers. Just a clarification about this annual gift exemption of £3,000. Is it for everybody? For example, if somebody got 3 children or 1 children, or is it per person, or is it for everybody?
No, it's depending on you rather than the beneficiary. So it's you are only allowed to give away 3,000 tax-free. That's not going to come into your estate.
1 person or 10 people.
Yeah. Exactly.
Yeah.
Mm.
Perfect. Property bought through limited company with 3 directors, including daughter, with equal shares. how inheritance tax gets affected in that situation with 3 directors, which includes daughter as well, with equal shares.
With equal shares. Oh, it's yes, I'd have to look at that in a bit more detail. It depends what kind of company is it? These sort of things, because
Yeah.
if it's a trading company, it'd be one thing. If it's an investment company, it'd be another thing. It depends on when the incidence is, who's dying. So there's no stock answer for that. That needs further investigation.
Sure, it's a personal one-on-one talk.
That's a personal one-on-one, yeah.
Yeah. And does a company do wills?
Yes, there are lots of will writing companies out there, and solicitors.
And would you do you offer as well? Do you offer as well?
I don't do them myself, but I do have people who I can refer you to who do provide that service. Yes, and actually, it's a very important service, and something you must keep an eye on is your will.
And somebody has asked about US stock investment considered investment business or trading business, and Boo has answered it as investment business. Hopefully that's correct.
Investments are, yes. Sorry, what was the question? I didn't quite get it. Are investments an investment business?
It's UK stock investment.
Yeah.
US.
US stock investment. Is that considered as an investment business or a trading business?
It's not a business. An investment in American stocks. It's just that would just be an investment, as opposed to a business.
Okay.
And therefore part of your inheritance tax, yes.
Yeah. Imran?
I think there's a question from Nick Kelly. If giving to spouse, then presumably they will have an inheritance tax exposure on their death. Is that
yes, that's right. Because what's the most popular thing is what people do is they have mirror wills, which basically says, I'll give everything to my spouse on my first death, and such that there's no tax to pay at that point, but of course those assets then end up with the spouse, the widowed spouse, and will be part of the widow's assets that will be inheritance taxable on her death, on her second death. So yes, they will be part of her estate.
and Boo has mentioned that there will be some mitigations you can do that by financial planning. Is that
certainly, yes.
Yeah. Okay.
Okay. Sorry. The next question is, what if somebody lived in UK for 15 years, but now living outside of UK for more than 10 years? So that means last 10 out of 20 years are not in UK. So what will be the status from their inheritance tax point of view?
I'm sorry, are you saying they just come back?
They lived in UK a long time ago for 15 years.
Yeah.
For the last 10 years, they have lived outside the UK.
Okay. Then they are outside of the UK inheritance tax net after 10 years.
Okay.
So yes, if they've been in the country for 15 years and then been away for 10 years, then after that they would be outside they would no longer be classed as long-term resident, because the tail is 10 years and they would be outside it. Are you talking about them coming back into the UK or not?
No. They're still outside the UK for the last 10 years. Yeah.
Yeah, that would be fine. They would not be subject. Oh, sorry, they would be on UK assets.
They will be.
Assets. On UK citus assets, but not on their worldwide.
Okay. I see. Yeah, got you. So worldwide assets, if they've been away for the last 10 years, doesn't apply to UK inheritance or taxes.
Yeah.
But the UK property or UK assets will still have to be taxed.
Actually, no, it won't be. It won't be.
It won't be, right? Okay. Again, I think one-on-one talk will be better in those situations.
Yes, yeah, exactly. Because
yeah,
it also depends on their domicile as well, actually, in certain cases. So it is quite complicated because they had a domicile situation before, and they still do to a certain degree, but the new long-term residency rules are taking over.
Yeah.
On that, can I come in here now in that this is a very difficult subject and we've had some good questioning now, but to reiterate what has just been said, there is the opportunity to discuss your own personal circumstances for as long as you like post this event. I think in terms of actual questioning now, and in fairness to Giles, we can stop the questions there now if we're happy with that.
Yeah, the last two questions, and then we'll finish it off. One is to do with wills. Giles, you don't offer wills, but do you have any specific good company to offer? Then please signpost it in the chat if you or Boo, if you can do that, especially with regards to Islamic inheritance rules from Will's point of view. And the final question is, Imran, can you ask the question from Nick, the last question?
Well, the Nick is actually maybe part of the team. Is he telling us?
Hey, Imran, we better ask this one because he's the boss.
All right. So he's asking. He's not asking. He's only giving a comment. Please register at the website, and we will arrange a no obligation introduction. So that's good. So he's
there you can tell he's the boss.
Yeah, that's what I didn't realize the first time when there was a comment, but the second time, obviously, it mentions about the website. The only thing that about Islamic will, there was a two component to the question, was saying that regarding your inheritance tax planning, what are the protections regarding Islamic rules of inheritance? Is there any, like with your advice as well as in UK rules?
Actually, there are some esoteric things that go on with, I'm afraid, with Pakistanis and Indians, actually, and it's a bit esoteric. I'd have to pick that up on an individual basis because some qualify and some don't. So that's actually a fairly murky area. But and the Islamic side, there are Islamic style investments as well. So again, these are areas that are perhaps not generic.
Yeah, thank you for answering all the questions. I think this was very important because majority of the audience in our webinar are probably Islamic background. So
yes.
I think it was a very important question to them.
Yes, and indeed, and on investments as well. A lot of them like to have, well, there are various degrees of Sharia-free and Sharia-compliant investment portfolios as well, which are fairly esoteric. And yeah, there are various different ones. So again, that depends on personal circumstances as well.
No problem. Thank you very much. So, Dr. Mansoor Ahmad, will you please say the final words and close the webinar with Dr. Naseem Mahmood as well?
Well, I would like to take this opportunity to thank everyone in the panel, first of all. So Imran Zamir, Ehsan Al-Haq, Naseem Mahmood, and also to Jonathan, who's been extremely helpful in organizing this webinar, facilitating this and hopefully future webinars. And most importantly, Giles Cooper, who's been of immense help. I think there were lots of things which were not clear to me before this webinar, which are becoming clearer, and certainly further advice would be even beneficial, I feel, for all of us. And also, I think I'll be failing in my duties if I don't thank the audience, who've been extremely we are grateful for their time over the weekend for attending this webinar and then posing some very important questions. So thank you all very much for attending this webinar. And I would like to ask Dr. Naseem Mahmood now to say final words and close the meeting.
Can I just please, after Doctor, can I just finish with the last comments from myself? But please go ahead now.
Jonathan, you want to go ahead first?
Okay. No, thank you. Okay, so I'll be school teacher here. Can we, if everybody looks into the chat box and looks specifically at a comment from my colleague Bhupinder at 12:23, this precis what I want to say, which is, firstly, thank you so much for giving up your time on a Saturday to listen to us, and specifically to Giles. He's the guy who's had the hard job, so thank you. But I'm sure, and I can see from the number of questions and the type of questions, this is something that has been exactly what we wanted it to be. It's thought-provoking, and you need to speak to our experts on a personal level to fine-tune your own inheritance tax needs and wants. And from the message from Bhupinder, to reiterate that, to get in contact with us, which will then provide you with a colleague who will discuss, do you want a face-to-face, remote, where are you, etc., etc. A very adept colleague. In order to do that, please jot these numbers down. The number to do that is 0800 316 1811. In terms of backing that up, the email is help@IFA. Let me explain. IFA is Independent Financial Advice, which is great because it means that my colleagues scour the whole of the market to get you the best terms. So to repeat, help@ifaadvice.co.uk. And I'll state the obvious, but if you don't contact us or use the QR code, which is also here, then we can't help you. And this is what we want to do. When I first met Imran in Manchester or Preston, was it, some time ago, and he told me of this concept of having a specific paediatricians group, and now it's come to fruition, and we've met and we've stuck to what we've said, which is have the first financial education webinar this morning. There are more to follow from NHS pension, etc. And it's a synergistic relationship that is important, but is also to be enjoyed. So you know how to contact us. I'm Jonathan. A lot of you, particularly the Exco, know my number. I'm always available. Please take the opportunity to engage with us. Thank you.
Thanks very much, Jonathan. So I think we're just coming to the end of the session, and I'm very grateful for the UKIPPO team who have put this webinar for our benefit and in collaboration with Jonathan and his team. So just a few things to say. I think you can never plan very well. This is Industrial Action Week for the doctors. So many of us, senior consultant, may be working as in hospitals. That may be the reason that they are not available to attend today. So we have recorded it and should be available soon. So this is one of our activities to use remote technology to have series of webinars on different topics. So there will be few more on the tax and pension and any other issues that members feel. So please do feedback and let us know what's in the need so we can fulfill that need. We will be having our second annual conference on the 5th of September in Northwest, hopefully around Manchester. We are almost in the process of confirming the guests and the venue and the programs. There will be some educational component with some social in the evening. So please mark that date as the 5th September and look at your rotas and the book in advance. As Imran has already mentioned, that we have our new website, ukippo.org. It's under construction. It's a very excellent start. And thank you very much, Imran, for doing that. So I think there's a lot of things happening. So be part of it. And thank you very much for joining today. So with that, we will conclude and we'll stop the recording. Thank you.
Thank you. Good morning or good afternoon.
Thank you. Thank you. Bye-bye.
Bye-bye.